Mark Minervini, Trade Like a Stock Market Wizard, How to Achieve Super Performance in Stocks in Any Market. Welcome to the captivating world of stock market investment. In this summary of A Trade Like a Stock Market Wizard, How to Achieve Super Performance in Stocks in Any Market, by Mark Minervini, you will discover the secrets to maximizing returns and building wealth. Learn how to identify stocks with stellar potential, defy conventional wisdom, and navigate the market with confidence. With a user-friendly approach, this summary covers topics such as the cockroach effect, the false allure of cheap stocks, and why even the average investor can outperform the professionals. Equip yourself with the knowledge and strategies to make informed decisions and unlock your full investment potential.
Beware pedigree, choose growth. The stock market isn't impressed by company pedigree or reputation, but uses past performance as a key indicator of growth potential. Observing the so-called positive or negative cockroach effect can offer insight on which industry or stocks to invest in. Seek out companies with consistent earnings growth and steer clear of those with ongoing disappointments in estimated profits. Basing investment decisions on track record rather than brand perception may appear obvious, yet it remains a counterintuitive approach for many. Everyone's heard the phrase, buy low, sell high, and for those who remember 2009, it seemed like a golden opportunity to invest in major companies like Citigroup, Lehman Brothers, General Motors, and AIG, as their share prices plummeted. However, this decline also indicated rapidly diminishing value, as evidenced when AIG's price crashed from $103 to 33 cents within 2 years, and it was subsequently dropped from the Dow Jones Industrial Index, along with Citigroup and General Motors. The lesson here is that the stock market focuses on track records rather than corporate pedigrees. If a stock's performance is in decline, it's unwise to invest just based on its reputation. Instead, look to the future and consider rising companies you might not have previously heard of. Enter the cockroach effect. In New York City, it's said that if you spot one cockroach, there are likely to be more lurking nearby. This concept also applies to stocks but on the positive side. If a company's earnings outpace projections, it often points to continued good fortune. So if an up-and-coming company is consistently exceeding earnings expectations, it may indicate a need to explore the entire industry. This positive momentum often leads to large investments in a stock before actual earnings numbers are published, creating a successful, earnings-boosting scenario. Should the trend hold, the numbers will continue to rise in subsequent quarters. However, this effect also applies in reverse. Companies that consistently fail to meet earnings expectations are likely to continue this disappointing pattern. Thus, when assembling your investment portfolio, focus on firms that have surpassed earnings predictions in recent quarters, and avoid those with a history of negative performance. While basing your investment choices on solid track records rather than mere brand prestige might seem like common sense, it's often less intuitive than we initially believe. Sticking to this principle can make a significant difference in your portfolio's success. Unleash your inner investor. Peter Lynch, a legendary investor, emphasizes that amateur investors have numerous advantages over financial professionals. Institutional investors face constraints due to their size and the need for liquidity, limiting their investment choices to larger, well-known companies. Additionally, they must adhere to board-approved selections, which leads to a focus on safer, conventional options to avoid blame if investments falter. In contrast, individual investors enjoy the freedom to explore smaller, potentially more promising stocks without the pressure of a committee scrutinizing their decisions. Modern technology provides individuals with the same tools as professional traders, empowering savvy individuals to make unique, lucrative investment choices. Step into the world of investing, where success doesn't come from being a professional, but from harnessing your inner amateur. Peter Lynch, one of history's most successful investors, famously declared that amateurs have the power to outperform the so-called experts. So why should you stop following the advice of financial professionals? For one, large investment managers face constraints due to their sheer size. They need liquidity to manage vast numbers of shares, which means they can only buy stocks in larger, well-established companies. However, success often lies with smaller, agile companies that possess a limited number of shares. Moreover, financial professionals typically work within the confines of board-approved companies, meaning they can only invest in popular, seemingly safe options like Google or Apple. But the truth is, nobody gets fired for buying IBM. When things go wrong, blame is shifted onto the market ecosystem, not the manager. It's all about staying within the perceived safety of the conventional investment zone. Fearlessly break away from the crowd, as individual investors can swim against the tide, exploring more lucrative investments without the scrutiny of a board holding them back. Armed with the same technology as professional traders, individual investors have the flexibility to make unique and extraordinary investment decisions, capitalizing on shifts and opportunities in the market. So forget about playing it safe. Instead, embrace the potential of unconventional investments and unleash your inner investor to find the path to true financial success. Unleashing Stock Superstars. Mark Minervini's Specific Entry Point Analysis, SEPA, approach uncovers stock market superstars by identifying promising young companies displaying clear upward trends in revenue, margins, and earnings. Applying the principle of time equals money, SEPA prioritizes stock growth rates and catalysts for growth, such as innovative products or valuable partnerships. By mastering the art of timing for both stock entry and exit, and establishing stop-loss points, SEPA users can transform potential superstars into lucrative investments. Mark Minervini's Specific Entry Point Analysis, SEPA, possesses the power to unveil stock market superstars. Cultivated from 30 years of trading experience and extensive research, SEPA transcends simply deciphering a stock's value. It zeroes in on rapid stock increases and the factors contributing to their growth. In essence, time truly does equal money in the stock market. Firstly, SEPA seeks young companies in the midst of an upward trajectory with growing revenues, margins, and earnings. Identifying superstar stock potential means pinpointing the catalysts that encourage meteoric rises to stardom. These sparks of growth may come in the form of innovative products, groundbreaking partnerships, or industry-altering developments. The game-changing potential of Apple's iPhones, Microsoft's suite of Office Essentials, and Google's search engine showcases the impact of such influential products. To attain superstar status, look for lesser-known, younger companies within 10 years post-IPO. Minervini, for instance, honed in on obscure companies in the early 1990s, such as US Surgical, which brought about pioneering surgical equipment. Despite some investors shying away from unfamiliar names, these are the companies most likely to produce superstar stocks. Next, it's crucial to time your entry into these stocks. SEPA offers guidance in capturing lower-risk price points before stocks skyrocket. Timing is of the essence, as poorly executed entries can lead to considerable losses should the stock plunge. However, seizing the right moment to enter can result in remarkable gains. Further, SEPA's mastery of timing extends to exit strategies. Not all potential superstars will yield substantial profits, even if entry occurs at an optimal price point. Establishing stop-loss points helps protect your investment by outlining specific conditions warranting a sale. Recognizing that every catch will result in releasing the stocks for profit, defining the best moment to exit is the final key to transforming potential into prosperity. By diligently observing growth trends, recognizing growth catalysts, and mastering stock entry and exit timing, Mark Minervini's SEPA strategy empowers investors to reel in the next generation of stock market superstars. By putting SEPA to work, you too can refine your ability to turn potential superstars into exceptional investments. Beyond P/E ratios. Embrace the notion that stellar investment opportunities can be found in high P/E stocks, which may represent cutting-edge companies with extraordinary growth potential. The P/E ratio should serve as guidance, but not overrule your own research and judgment. Instead, pay attention to the potential for growth and avoid being lured by cheap stocks. Trust yourself and remember that you are your greatest advocate. In your pursuit of stock market success, recognize that you might be your own biggest obstacle. Commit the necessary time, belief, and focus to reap the rewards of this endeavor. The renowned trader, Jesse Livermore, defied adversity during the 1920s market crash and uttered the powerful truth: Wall Street never changes, the pockets change, the stocks change, but Wall Street never changes, because human nature never changes. As you delve into trading, avoid getting caught up in the price/earnings (PE) ratio, the stock's price as a multiple of the company's value. It is a common misconception that high PE stocks should be steered clear of. However, Minervini observed that potential superstar stocks often experience rapid growth in their market rate, which justifies a premium price. Rather than feeling intimidated, this should be viewed as a promising indication of a company's cutting-edge advancements and potential impact. Reflect on the uncertainty surrounding the internet in the 1990s, leading to the explosive rise in tech stocks' value. Minervini bought Yahoo shares in 1997 at 938 times its earnings, a remarkably high P/E ratio. Despite its unfamiliarity and skepticism from fellow investors, within 2.5 years, Yahoo's growth skyrocketed by 7,800%, with its P/E ratio inflating to over 1,700 times its earnings. If you'd invested at that time, you would have enjoyed immense profits. Let this example serve as a lesson: view the P/E ratio as a gauge of popular sentiment, a measurement of the market's current valuation of a company's earnings. A high P/E ratio signals high expectations for a portfolio, while a low P/E indicates lower anticipation. Traders often mistakenly overvalue low P/E stocks, concentrate on growth potential and use the P/E ratio as a guide without permitting it to dictate your decisions or hinder your research efforts. Avoid the allure of bargain investments. Falling into the trap of buying good deals can make it challenging to sell when the value plummets, creating a downward spiral for investors. Focus your time and money on companies displaying signs of exceptional potential. Generally, the quality of investments reflects their price, which should serve as both a warning and encouragement to work diligently and trust your instincts. Success in the stock market does not require a mathematical genius. The SEPA methodology emerged from decades of trial and error, failures, and successes. Embrace the willingness to learn from mistakes and strive to discover the approach that works best for you. Finally, remember that no one else is as invested in your well-being and success more than you. By placing your trust in your abilities, you'll be better equipped to navigate the stock market and achieve prosperous returns. As Henry Ford wisely said, there isn't a person anywhere who isn't capable of doing more than he thinks he can.
As we reach the end of this enlightening journey through Mark Minervini's Trade Like a Stock Market Wizard, it's time to reflect on the key takeaways. Remember to focus on growth potential rather than falling for the trap of cheap or well-known stocks. Be prepared to challenge conventional wisdom and trust in your own instincts when investing. Don't be afraid to take calculated risks in pursuit of superstar stocks and learn from your own experiences. Finally, remember that with persistence, dedication, and the right strategies in place, success in the stock market is achievable for anyone. Empower yourself with this newfound knowledge and begin the journey to financial growth and independence.